This is the Skin in the Game VC podcast, hosted by Tom Wallace, entrepreneur turned venture capitalist and the managing partner at Florida Funders, along with Saxon Baum, general partner and head of investor relations at Florida Funders. You'll learn from the best about investing in early stage tech companies, so you too can gain the confidence and find the tools that help you succeed as an angel investor. Are you ready to get some skin in the game?
All right, everybody, welcome to another episode of the Florida Funders Skin in the Game pod. We are so happy to have you here. Tom, how we doing?
Great, Sax. Congratulations on the birth of your new son.
Thank you.
Very exciting. Very exciting.
So far, so good. You know, I'm really doing a lot of work around
I don't know how many people know this in our audience, but Saxon's actually my nephew. So I have a new grandnephew.
There you go. How many do you have? 4.
Yeah, I guess 4 now.
4. There you go.
Yeah. Not all nephews. Some nieces thrown in there, grandnieces.
Right. So. Well, usually Tom would do the kickoff of the show, but we're lucky enough today to have one of my very close friends on the show, a very successful entrepreneur and investor, Rohan Shah. So, Rohan, welcome to the show, and thanks for being here.
Yeah, thanks for having me, guys. Congrats on your little one. I bet you're just sleeping more than you ever have right now.
Oh, yeah. You know, just ask my wife. She'll tell you all about it. You know, I'm very active at the baby front in my house.
Both work and baby front, it sounds
exactly.
like.
It never stops.
Well, welcome, Rohan, and we're excited to have you on the pod.
Great.
Thanks for joining us.
Thanks for having me.
So, kick it off, Rohan. Why don't you just tell us a little bit about yourself, kind of how you got to the position that you're in today, and then a little bit about Extend, which is the current company that you've been running.
Yeah, for sure. So quick background, I grew up in the Bay Area, so have sort of been around the technology world for my entire life. As I was kind of just mentioning to you guys, was fortunate to have 2 parents who went through that entrepreneurial journey themselves. So they started a company together back in the late 80s, ran that company for many years, sold it, took it public. So I really got to see from an early age. I don't think I really understood necessarily at the time, but see from an early age just what grit, hard work, and kind of, having a miserable life for a while can look like in the
trials and tribulations of entrepreneurship, right?
For sure. I joke with some people sometimes, like, this is not a joke. Weekends, I was basically babysat by people on the floor, on the manufacturing floor at their company. And Saturday afternoons, I would get my, McDonald's French fries my dad picked up for me, and I'd sit in the boardroom while they had meetings. And so probably a lot of that by osmosis has plagued my brain.
Yeah, exactly. Running board meetings at the age of 2 or 3.
Yeah, exactly.
Yeah.
But you pick up, the language and the vernacular pretty quickly when you're in situations like that. So, long story short, I think I've been around this space for a long time and have been fortunate to see a lot of people work really hard and be successful, which has been cool. But so grew up in the Bay Area, went to Stanford, as you know, Sax, started my first company right out of college. So ran that for about 3.5 years. Awesome learning experience. Never been punched in the chin so many times in my life.
What was that company?
Basically, what we were trying to do is build less of a transactional experience around recruiting. So rather than recruiters being sort of the conduit for a lot of large companies, our whole premise was that the high qualified talent that's in the market doesn't want to talk to a recruiter. They want to talk to someone that would be on the team that they would actually be working in. So how do you leverage employees as sort of brand ambassadors for the overall business as you look to bring on top talent? And so we built a community rather than a marketplace to really support that. Did really well in terms of talent acquisition. We had like 4,000 individuals in the Bay Area who were super high qualified talent, basically meeting other people on the platform. Problem was it was really hard to move up market, right? We sold to a lot of startups who would pay us on a recurring basis, effectively a subscription fee to get access to our talent pool. So there were no placement fees necessarily. The problem was the hiring cycles would swing so dramatically with startups that you couldn't really build a solid recurring business there. So that was where we sort of took a step back, decided, hey, there's probably a lot more for us to figure out just for ourselves professionally. And so we ended up selling that for a small acquisition just for the assets. And then I left and went.
Well, one thing real quick on that, Rohan, as somebody that's hired a lot of tech people in my career, I've always found using recruiters to be a very frustrating experience.
Very
So
frustrating.
you saw a problem that really exists and has existed for a long time on both sides. I think it's tough on the candidates, and I think it's tough on the employers because we end up paying 25-30% of their first year's salary, and for arguably somebody just found them on the internet quicker than we could. So I applaud you for trying to solve a real problem out there.
I agree. It is a real problem. I don't know if we solved it is the challenge that I had, right?
Yeah.
I think it's just a really entrenched world. And I think that was probably the best.
Definitely. I mean, we've talked about this so many times, Tom.
Yeah.
It's really hard to get people out of their existing point of view on how it should be done. Here's the crazy part. When you look at the stats, our retention rates were way higher for candidates that we help facilitate. When you look at the stats, our productivity rates were way higher for the employees that we place. And when you look at like culturally, they got to meet with people that they would be working with directly, not in a hiring or interview process setting. And that was like the biggest point is they had an advocate and a champion internally on day one when they started who wasn't just their boss. And like people forget sometimes, especially in this like weird remote now world that we kind of live in, that like those relationships are why people stay at most companies when they aren't an executive or a founder with a ton of equity, right? And so really interesting dynamics. It was just a really hard nut to crack, to be honest.
Tough business.
And I was 23 and didn't know what I was doing. So that was good.
To boot.
I bet I did the same thing. I've been there.
But it's the best learning experience you can have, right? At the end of the day.
I started my first company when I was 23 with my best friend. So what could go wrong there?
Yeah, and me with my cousin who was a best friend. Now I just call him a cousin. You can know how that whole story went.
Yeah.
Well, I started with my sister, so there you go.
Oh, there you go.
Are you still talking?
We still talk. We still love each other.
Perfect.
Not every day, but most days.
Is she still your business partner?
She is not my business partner anymore. She's moved on to greener pastures and decided to start a company with her husband. So she's a glutton for punishment for sure.
I will say that my best friend is still my business partner this day and 4 decades and 4 companies later. But not to go back to you.
No.
After that startup, what'd you do?
Yeah, so I decided I needed sort of something with a brand on my resume, and then for me, the biggest challenge we had, as I sort of described to you guys, was we struggled to move up market. And so for me, what was critical was just how do I figure out how to build both a product and a business and sell it to the enterprise? And so I started to look for opportunities where, as a 24 or 5-year-old, I could be in the room with executives, understanding their buying process, how they think about sort of digital transformation at large in the industry, and what mattered to them at the end of the day. And so the easiest place to go for that was consulting. And so I went to BCG. They had a group called Digital Ventures. They've changed the name like 8 times, so I have no idea what it is now. But basically the premise of that group was, how do you build innovative software products for the firm's Fortune 500 clients? So go through a management consulting exercise where you do need finding, talk to customers, understand the value chain, and then basically come up with like 5 to 7 business ideas that could be relevant for them. They would then decide if they were interested. And if they were, we would kick off a process. Could be, I ran a project for 18 months where we would effectively build out new platforms for these companies in a time span that would have taken them probably like 5 to 7 years and might have gotten thrown out in the middle, right, with leadership change.
So it was almost a starter studio
That's
inside
exactly
of
where I
business
was going with
inside
it,
of
yeah.
BSG?
It was a startup studio. And interestingly enough, there were businesses that we would spin out and capitalize separately and turn it into a new co, with the corporate partner being effectively a large shareholder on the cap table. Mm-hmm. However, if I'm being honest, I really hated that part of the model. I just thought it was like a perverse set of incentives, and you couldn't build a great long-standing business without having founders that had founder level equity on the cap table. And that was really the challenge for them, is who do you hire to run a new business that's super risky for 2 points on the cap table? No one that you want to hire.
You're not going to get the best talent for 2 points on the cap table.
You're not. You're going to find another corporate person who's excited about working on a startup-y type project, who's never seen building a startup from 0 to 10. Yeah. And that was always my challenge. So what I focused on more was like digital transformation products, things that were relatively more obvious, I would say, in their paradigm, but were critical things for the large Fortune 500s to think about. As an example, largest bank in Canada, they didn't have a digital wealth management product. they couldn't engage with their clients through technology. You had to go into a branch, sit down with a person, and they'd pull out a pen and paper and walk you through the modeling. So building an online virtual sandbox environment to play around with your home loans or car loans or vacation spend needs or whatever that may be, to me was just like obvious. And it helped the business because it saved them from some of the competition that was eating their lunch on the wealth management side. So
how did you see, I want to double click on that because that's something interesting. We always talk about antiquated industries and how hard it is to transform these industries digitally. How did you see the adoption of that technology after you guys would build it?
So it's a B2B2C product in how we built it, right? We built it for the bank, but it was for really the bank customers at the end of the day. It's now the largest penetrated wealth management tool in Canada, as an example. For us, it wasn't just how do you help people who want digital tools for wealth management. It was how do you access individuals who didn't have a high enough net worth to justify having them come into a branch. If I'm sitting on $70,000, no wealth management person wants to talk to me because I don't have enough money for my account to be relevant. Could you automate the handling of those folks through virtual agents through the platform as well? So it was both penetrate the market of people who are already getting these services, but also create a market of people who otherwise didn't have access to those services. And so it was interesting because you come in with a massive brand. You don't have the struggle of like, I'm a startup. Like I could slap my name, which was the bank's name, as basically our product. So you get instant distribution. And to me, on the product side, what that tells me is I get instant feedback on sort of what's happening and what's working and what's not working. So it was awesome from that perspective. What wasn't awesome is like, I don't like working for other people. And that was always a challenge for me.
There's that.
That was a small piece. You know, they would tell me like, grow out your beard, wear glasses. You're 27 years old, sitting in a room with the C-suite executives of the largest bank in Canada every single week. And I was like, who gives a shit what I look like? Like, if I'm saying what I should be saying and it's valuable for them, isn't that me doing my job? So there's just like a lot of bullshit and optics and politics that were challenging for me. I didn't like saying stuff that I didn't think was true. And they were like, no, it's client management. And I was like, no, it's bullshitting is what it is. But I get it. It's part of the business, right? And like, I'm probably not well suited for a business like that at scale, but it was an awesome learning experience for me, which is why I was there.
Well, most entrepreneurs, it usually works the other way where an entrepreneur has a successful exit. They sell out to a corporation, then they agree to stay on for some period of time. I've seen this movie so many times. My friends, I'm like, you'll be lucky if you make it a year.
Yeah.
You know? Us entrepreneurs don't fit into the corporate world very well, typically.
I have friends with the timer on their cliff, like literally.
Like the second your earnout's over, you're out of there.
This thing says 3 months left. That's when I know I'm going to stop looking at emails, basically.
Yeah, you're good. You know, you can't catch up at that point.
Yeah. How long did you last in that wonderful corporate world of BSG?
I lasted longer than I would have expected. So I lasted
BCG.
3.5 to 4 years ish.
Okay.
But again, the projects were 16 months in some cases, right? So it wasn't like 3-month churn and burn type projects.
Mm-hmm.
I think management consultants like that because it's exposure. The problem I had with that is like, I don't think you actually learn anything meaningful in 3 months. Like you might feel like an expert and then you're going to get punched in the face when you realize that you actually don't know a ton about what you're working on. So like I loved sinking my teeth in deep and kind of seeing something through. The problem is I would launch these products and they were like, great job. You're off now. And I'm like, that's not at all what the outcome that we're trying to deliver.
Yeah. I want to see what's going to happen here. I want to follow this thing through.
Yeah. And so that was really tough for me too, just from like a personal satisfaction perspective. But yeah, 3.5 years. So lasted a lot longer than I thought I would. Spent the last 6 months basically because I had leverage over them on a project that they needed me on and told them I wasn't going to travel and I was going to go figure out what I wanted to do next, but they could pay me. So that worked out nicely.
There you go.
So what was next?
So what's next is what I'm currently working on. So started this company Extend just over 6 years ago now. So towards the end of 2018 is when we started really thinking about the space. But, I saw in your guys' questions just sort of the founder story. So maybe I'll start there. I know Saxon is. Tom, are you a sports fan?
Oh, yeah.
Yeah.
Big time.
Cool.
March Madness coming up.
I know.
So excited.
a lot of text going on.
We're going to our auction tonight.
We were strategizing earlier.
Yeah, we were strategizing our bracket.
we had a big text thread going for our auction last night, and we ended up with only Duke, which means for the first time ever, I'll actually be rooting for Duke. But
I'm an Auburn fan. My daughter went to Auburn, so
y'all look good. Y'all look good. Bruce Pearl, good coach.
yeah.
But so the company kind of started after a weekend of sports betting. So my business partner and co-founder, a guy named Woody Levin, he sits on the board of a company that you guys know called DraftKings.
Very well.
And so, I got a call from Woody one Sunday. There may have been a couple of beverages involved. It was one of the first few weekends of football season. And he basically called me and was like, dude, I had a lineup with the CEO at DraftKings, Jason, and my running back, James Conner, got hurt. And I lost, obviously, because my running back didn't put up any points. What if we could build an insurance policy for a daily fantasy sports lineup? So you can model out expected values. If there is bad weather, the player gets benched, they get injured, company keeps the insurance policy, individual gets their entry fee back. And I was like, I love this idea, right? I'm obsessed with sports. I'm not great at math, but I'm good enough at math to understand how it can work there. And so we started looking at it, and Jason was like, you build it, we'll implement it. We're not going to prioritize building this. But the more we sort of looked at it, you guys know you're in the space yourself through some of the portfolio companies you have, but it's just a weird industry to try and build regulated insurance products in. And
you think?
Wow.
Even from there, like the overall GMV of the industry itself, like what, $7-8 billion now, maybe, like that's not big enough to build a company. That's a feature in our minds. And so I was still at BCG, and we started to take a look at like, what effectively are we building and where does it exist today? And it exists and has existed for a long time in retail, and it's called an extended warranty. And so we really started digging into this space of extended warranties and protection plans, trying to understand just like, what are the mechanics? I'm not an insurance expert, nor is Woody. I'm not a retail expert, nor is Woody, but we're consumers. And we go through Amazon's checkout, Walmart's checkout, Best Buy's checkout, and more. And you get offered an extended warranty on every single product that they can offer it on. And yet, after walking through a Best Buy and seeing the iRobot vacuum and the JBL headphones and the Sonos speakers, not one of those companies had an extended warranty on their direct-to-consumer website. So you're sitting on a financial opportunity where there's customer demand, and yet there is no offer to a consumer.
And what, it was offered through the retailers, but not D2C?
Through the major retailers, never through smaller channels like D2C and more. And so take a look at Best Buy. Let's use them as an example. Best Buy in 2020 or 2021 did 2% of their top line revenue on the sale of extended warranties. So 2% out of $45 billion in GMV was on extended warranties. And that 2% of their top line translated into 52% of their net income. So more than half of their net income came from the sale of these protection plans. They're almost an insurance brokerage rather than a retailer at that point, right? And what they'd figured out is we can make a massive business and a ton of EBIT on services. And we can sell the products for cheaper and be a conduit to acquiring that customer into our store or onto our website. And so we're sitting there and we're like, all of this money is being left on the table by these brands. Why is that? And that's where we started to really formulate our point of view on this business itself, which was there was no distribution. So large insurance companies who would provide the balance sheet exposure, the underwriting for these programs, basically said, if you do less than $3 billion in sales, we can't support you. You're just way too small for us. They had no technology. They would effectively give the brand a spreadsheet and say, here are your costs, go figure it out. Brands wouldn't figure it out. So we built a platform that would basically insert ourselves in and manage these programs from start to finish. That's both technology on the front end to walk customers through the buying process. So think about an e-commerce app or in-store merchandising and stuff like that. We manage all of the claims and administration around those problems. And then we also now are our own insurance entity. So we're underwriting every single policy in the market today on our own books, which allows us to control that experience. And so digitizing it, making it easy to use from a distribution perspective, and really, really, really improving the customer experience were sort of our core competencies. And it turned out there was a really solid opportunity in the market for that too. And we had seen companies do this, companies like, Affirm and Klarna.
I was going to say.
Called layaway and didn't tell my friends about it because it wasn't cool, and turned it into like a sexy buy now, pay later product. And it's the same thing.
Same thing.
Distribution mechanism, right? And so that's really where we started. And the business has since obviously grown tremendously, and we've been very fortunate. But it's been a pretty cool journey.
What type of companies, Ro, are you guys working with? I mean, what's like a core customer for you guys? Is it consumer electronics? Is it large big box retailers? What is it?
It's a good question. I would say it's changed over the years, not surprisingly. First couple of years, I think I would call it sort of logo hunting days, like where we would sign anyone and anyone with a pulse, basically, that wanted to work with.
As long as they can fog the mirror, right?
Yeah, exactly. But that was also somewhat intentional in that.
Yeah, that's good. That's how most startups do.
Learn where the product works and where it doesn't work. And luckily, we were pretty damn good at sales, I would say. And we were able to acquire a lot of these customers, get them on the platform, and start seeing how they would perform. Everyone would tell us, look, extended warranties is the only industry where this really works. Cool. Turns out that's not our biggest category, and that's not the most profitable category we have. So there were a lot of just assumptions and misconceptions, I would say, that we went into it with, that we had to pressure test and validate or disprove in many cases, right? Which is productive, to figure out where our ICP was. I would say for us today, sort of 3 or 4 categories that we've been really successful. Furniture being the biggest of them. That's our best and highest performing category. Consumer electronics for sure. And I would include sports and fitness sort of within that. Folks like Peloton, who we work with.
Peloton's the world. What's your thing called?
Tonal. You have it.
Tonal.
You know those guys? He's got a tonal right there.
You better have bought that extended warranty, Tom. But folks in that
I'm not big on the extended warranties, but I love your business.
You're self-insured. We know that.
I'm self-insured. Exactly. Yeah, I'm a self-insured. Good way of putting it.
But so
Peloton had to be a huge account. Has to be a huge account.
It's one of our very early enterprise customers too. So I would say we helped them in a number of ways, and they helped us in a ton of ways as well, right? Just having what we would call a lighthouse account for us, really category opener. And we signed with them at a great time before COVID, where stuff started to get really crazy through COVID.
Oh yeah, that company blew up during COVID.
Oh yeah.
Yeah, wow. We had a blessing, honestly, that we had a year to build before COVID happened, because we basically got to a point where we had the nuts and bolts from an infrastructure and architecture perspective put together, and we were able to support a customer of that size and breadth. So that was, lucky.
And were you able to underwrite them right from the beginning?
No. So we partnered with third-party insurer to underwrite them at the start, and then we migrated everything over to our book. It took us 2.5, 3 years to build out all of the infrastructure you needed for insurance licenses and underwriting licenses and stuff like that. But yeah, so consumer electronics, auto parts is a big category for us. So we work with Advance Auto, and then pretty much every D2C e-commerce auto part retailer that you can think of. Jewelry is a big category for us. We work with Brilliant Earth and a bunch of other well-known sort of I would say fine and engagement jewelry type brands. Optical is a big category. So if you've ever been into a Vision Works, as an example, to get glasses, we work with them. So a lot of really great categories, but all durable goods, as you might expect, right? When you think about something like an extended warranty, the business since then has expanded. And so we now have other products that are maybe more relevant for other verticals as well.
So I want to go back because you are not our traditional guests. Most of our guests, I would say, are typically entrepreneurs, but are not Silicon Valley based. We've had a few, but we're in the Southeast. You had a very entrepreneurial focused growing up with your parents, going to Stanford. How did all of that play into the current business now? And do you feel like that was a real kind of advantage for you, being surrounded by these types of people and these types of resources, and probably being able to pick up the phone and get to VCs that maybe entrepreneurs in the Southeast years ago didn't have access to?
1,000%. I don't think I'm as grateful as I should be at all times for sort of that. The way I sort of describe it to people is there's a serendipity quotient in the Bay Area that is hard to replicate everywhere else. You think about, I was lucky enough to go to a nice high school, and my high school is absurd as it relates to the talent and people that have come out of there. I think I have the 3rd highest enterprise value from a founder perspective in my graduating class, to give you a perspective.
Just in your graduating class?
From high school.
High school.
That's crazy.
Was it a private school or a public school? I'm curious.
Private school.
Okay.
Now it feels like a college. I went back there a couple weeks ago.
Yeah.
But, it's crazy, right? You just like the talent you're surrounded with, and like the talent came from the people who made those kids, right? So the parents were all incredibly impressive. I would say my high school was also heavily first generation, Americans. Like my parents weren't born in the States, and many of the folks I went to high school weren't.
Yeah.
Love that.
And
You're living the American dream.
It was the American dream, to be perfectly candid, right? And it was hard work, grit, and a lot of hustle stuff that, like, I think I demonstrate, but I can't possibly imagine how much my parents had to demonstrate it, right? I had it way easier. And so I think being in that environment teaches you a bunch for sure. But I would say for me, Saxon, you know me, like, I'm an athlete. That's the way I think about it. It was the competition that drove me. I didn't care a whole lot about school, but I didn't want to look like a dumbass either because I was competing with everyone around me. And so, like, rising tide lifts all ships was so true for me. Like, you talk about Stanford, I didn't take advantage of Stanford in maybe the traditional way. Like, I hated going to class. I did everything I could to not go to class. But there were certain classes that I really loved. And those classes I would lean into heavily. And I still have relationships with professors and stuff there. Those professors are people that venture capitalists reach out to, right?
Yeah.
Which are the students that you really love right now that we should start building relationships with. I had classes where I was pitching to VCs. Like, that seemed normal because we went, but that was not normal at all anywhere else.
Didn't happen at IUP or Miami of Ohio. A little bit different.
Well, but still, the hard work part, I think, is an underlying theme that you learn from your parents. And I can speak to my parents, and Sax's parents are very hardworking people. So, but we certainly didn't have the network of talent that you have there in the Valley. Although I think you would agree, maybe you won't, that's shifting, and that, now you see pockets of that in other places, and with people working virtually and having access to talent anywhere, the game's changed quite a bit.
The game's changed quite a bit, and also the landscape has changed quite a bit, right? Like, I always tell people, like, it's great to hire a bunch of engineers in San Francisco if you need deep technical AI-related expertise. Would I hire a team full of people in San Francisco if I had basic engineering work to do? Absolutely not, right? Like, there's great talent in San Francisco, don't get me wrong, but then there's a cost equation to it as well. And the cost is crazy in San Francisco.
What is a top AI data scientist going for these days in the Valley? I'm curious.
It depends if they want to work at OpenAI or if they want to work at a startup, kind of. You can't acquire talent compared to these bigger companies right now because they're willing to spend so much. Like, I won't name their name, but like, I know someone who got hired by Meta as a PhD AI researcher. And they explicitly told him, we're going to pay you $1 million a year and you're going to get $500,000 in stock every single year. And our whole goal is we don't want you to go to OpenAI.
It's crazy.
Wow.
And I'm like, I'd take that. Maybe I should have gotten a PhD if I
I'm going to go back to Stanford.
Somehow I think Elon's behind that.
Seriously. But like, those are the types of things.
You can work for Sam Altman. That's all I care about.
You talk about Stanford, and like, for me, it was different than for others, right? But for me, like, the network that I built at Stanford, and that's what I spent a lot of my time on, i.e. like, I partied a lot, but like, you build a lot of relationships with people there that have continued to be people that I have relationships with as you grow up. So when
it's like Shannon Wu. I mean, we put that together recently when we were together, that, you went to college with her, and she's an investment that we made in Open Home. And it was just really cool to see that. Probably a little bit of different college experience between you and her, but exactly what you're saying.
Yeah. To put it bluntly, like, for me, I was very, very focused on the work world. Like, I had internships every year. I always was working at companies. I loved the notion of building value in a business. Again, probably because of my upbringing to a certain extent, but like, I loved hustling at work. I didn't love the classroom environment. The classroom environments that I liked were ones that were geared towards the real world. Like, let's build an example of you putting together a business plan and let's go pitch it to investors.
Yeah.
I could get behind that, and I would spend hours at night working through that. Whereas, let's read this paper and write an essay about it, probably wasn't my favorite thing to do, nor did it feel directly relevant to what I felt like I was going to do. So it was kind of like a pick your own adventure time. And like you could really get away with murder, not literally, but like anything you wanted to do, you could do at Stanford. You wanted to golf and play tennis all day. Like there was a path for that, to be honest, which is kind of a unique thing about it, I think.
Yeah, it's really interesting. Why don't you talk a little bit about, let's go back to Extend and let's talk about fundraising. So you've raised a substantial amount of money for this company. I don't know if you want to share what the valuation is and what you've raised, but I know a lot of that happened in the ZERP era. How has that played out since you got that large investment? Was it 2021 when that investment came through?
Yeah, we did a $260 million financing in 2021.
2021. So how's that all played out? Because obviously we're in a much different time, and we always hear like on the All In pod, oh, you raised all this money in the ZERP era. How has that played out for you guys?
For sure. I would say look, first things first, what a crazy period of time, right? I sit on both the investor side and on the founder side. And so I'll take it. But it was crazy to me, even personally, right? And we saw a lot of opportunities on the investing side that we just passed on, because we were just like, I have no idea how to underwrite this. Like there's no math involved here. It's all vibes. And so I think for us, it was a crazy amount of money, and we definitely were ahead of our skis in certain areas. We hired too much, as an example, early on, because you think cash continues to be free, and it will continue to be free effectively. And then things change. I think for us, the thing that I'm most proud of, like there were hard decisions, but is we made hard decisions really fast and really early. And I think that allowed us to get back to what was more of a steady state and focus on, let's get profitable. This is a business that can absolutely be profitable in the next 2 to 3 years. Let's focus on being profitable and manage our cash appropriately to do that. So we haven't had to go out and do another fundraise. And in theory, we don't need to ever do another fundraise. And I think that leverage was really important for us to prove to ourselves that we can get there. Now we're kind of there, right? And have sort of that light at the end of the tunnel. I think it shifts back to like, what does growth mode also look like now? What are the opportunities? And let's be really specific about where we invest as it relates to those opportunities.
Yeah, it's really interesting. And that story of you raising that amount of capital, do you want to go into that at all? I know it's a pretty interesting story.
Yeah. I'll probably spare a lot of the gory details, but we raised from SoftBank, right? And like, I'm very thankful to them for giving us the sort of round that we got and allowed us to get to where we are today, right? The process itself was quite weird for us. Like we did not go out trying to raise $250 million. That was not sort of the plan necessarily. But we had an interesting conversation with Masa himself, my business partner, what he did. And, it was a strange call, to say the least. He's an interesting, unique, obviously incredible.
How did you get to meet him? How did that come about? Did he find you guys, or
the partner who was managing our deal cycle basically said, like, we have to go through Masa, and there will be a call that you do with Masa through that process. So they facilitated it directly. Didn't seem like he moved for 10, 15 minutes on that call. I hope he blinked, but basically we talk about ourselves like Apple Care for everyone. At the time, we were just doing extended warranties, not some of the other products we now have. And so as soon as we said that, he was like, I love Apple Care, high margin business, like, let's get it going. And at that point, it was like, you need to raise $500 million. And we were like, holy shit. Like, I don't think we do, but how do we do this now? And so we landed on $250 million, I guess. But it was a really interesting, weird experience. I think all of us were like very clear about the fact that valuation was crazy. Just let's be candid and clear. I think we've grown into it, which is the awesome part. Without having
it's great.
Money. Good for you.
But it was a weird experience. Weird and fun and interesting, and it's something I'll never forget.
Yeah, really cool. Tom, want to get a lightning round, or do you have any other questions?
Oh, I was just going to ask you, what's the vision for Extend? What's the exit strategy? Kind of share with us what you see the future Extend looking like.
Sure. So I'll tell you what I'm like super excited about right now. We have a awesome core business that continues to drive pretty significant amount of top line and cash flow for us, which is great. That's the extended warranty side of the house, sort of a known entity. It's not new. It's better, faster, cheaper is how I would describe it for folks. And that just continues to grow, right? There's more enterprises that we can continue to sign up. Those deals are large. More recently, what we've done, though, is if you think about our business, there's sort of three core components to it. There's the front end component of it, which is services or marketing opportunities to consumers as they buy products that could be online or in store. There's a middle component of it, which is if or when something goes wrong, how do you manage that problem? So that's claims management, claims administration. Not surprisingly, within that bucket, we've always been looking at fraud, abuse, bad actors, because we manage a portfolio, and that portfolio is ours and our balance sheet, right? And so we've always taken a hardline approach towards how do we identify these bad actors based on telemetry or behavior or documentation or what have you. And then the last piece is the underwriting, right? The actual risk components to that business. And so as we started to look at the landscape, what we realized was we were only serving customers that purchased a service product. So if you purchased an extended warranty, or if you purchased shipping insurance, which is another one of our products, we would then take care of you and we would manage it in an automated manner. We would mitigate some of the fraud and bad actors, and then we would fulfill on those claims. i.e., if your couch got broken, Sax, we would send a technician to go repair it. Or if your glasses broke, Tom, we would send you a replacement. So like we would fulfill on everything as well. And what we realized was that's the exact same value chain that brands and retailers are going through after the sale. So when a customer calls in and says, my package got stolen, that's a risk touch point. If you send out an appeasement, you're doing that at cost to yourself. That's now a negative unit economic transaction for you, where you're hoping the LTV works out for that customer. Similarly, for a return, if you process a return, that's a risk-bearing touch point. And what people found is within each of these risk-bearing touch points, there was a ton of fraud. So customers calling in saying, I didn't get my order, when in reality, they just want 2 t-shirts from that company. Or customers processing a return, getting a refund, and sending back a box of bricks. And so it was hard for brands to really identify what was going on, who are these bad actors, and how is it impacting my bottom line. And so our new product that we launched recently really helps solve for those operational problems. It's not as opportunistic of a top line revenue driving solution, but I would say it's more of a painkiller for these brands in terms of problems that they're dealing with today. So that's a product that, we launched end of last year, early this year.
Kind of Doge for businesses.
A little bit, yeah.
At least the fraud part.
If we were only firing the fraudsters, yes. But that's probably where I see our biggest next inflection point, right?
And do you take this company public at some point?
I think if that product goes really well and continues to go really well, there's a really meaningful opportunity to do that. I think there's probably like $500 to $750 million in ARR with this product based on the TAM that's out there. So yes, is the simple answer. I think if we can really hit like an accelerated inflection point, get back to like, really meaningful triple digit growth and more. Otherwise, I think, it's probably more of a strategic play for a larger company. The nice part is the space that we're in has a lot of large balance sheets.
A lot of big players.
Insurance companies, when rates go down, they have to become acquisitive because they're not making money on their reserves anymore. Same goes when you look at like logistics companies like UPS and FedEx and DHL. Like they love these sort of problem solvers because it helps mitigate a lot of costs for them. Yeah. And it creates a better experience around them as a carrier too.
Well, so it sounds like you built a great company. I don't think you'll have any problems with finding somebody who would be interested in it.
Still building.
Yeah, still building. Well, continued success. So running out of time, we finish up with a lightning round. I'm just going to ask you a bunch of quick questions, quick answers. I always like to start with Bitcoin. We sit here; it's just gotten hammered pretty well from its high over 100,000. I think it's at 81 or 2 or something like that today. What's the price of Bitcoin a year from now, in your estimation?
God. Our president makes this harder for me to shoot at a moving target, but I'd probably say like 150 grand. Like I think it'll continue to go up. I think
so. You're bullish.
I'm definitely bullish. Continue to buy more and more, especially as it's been dipping. So bullish in that regard for sure. My business partner, co-founder Woody, he actually ran like a crypto hedge fund before we started this company that I was an investor in.
Nice.
he's definitely the better person to ask.
So is he bullish as well?
He's bullish, but we are not putting our claim reserves in crypto just yet.
Okay, all right, there you go. So you're not that bullish.
You're not Michael. What's the MicroStrategy
Michael
guy?
Saylor.
Yeah, Michael Saylor. You mentioned the next question is going to be AI is going to impact everything, as we all know. It's going to create jobs. It's going to kill jobs. I heard you talking about claims processing. I'm sure that I'm assuming you're using some AI bots already in that. Net, do you see AI as a job creator or a job destroyer?
I think there's going to be different phases sort of what it looks like, right? Like I think the early phase, it will kill some jobs for sure. I don't see how it doesn't do that. Like already using some of these tools, both as like an individual, but also as a professional, like you will not need to hire people to do as much of the menial tasks that exist, right? I think that's, to me, obvious, but maybe not to everyone. I think where I'm maybe different than others is I think it's going to be a huge augmentation layer for your better talent. So talent that understands how to leverage it and activate it in the right way is going to be the talent that succeeds. And it's going to be the talent that you keep on board at a company and find ways to keep on board at a company. Because the individual, I think about my sales team and it's all across the board. I don't force people to use AI tools necessarily, but if people aren't, I'm kind of curious or wondering why they wouldn't, right? Because it's a huge productivity tool. So like, I think about like the augmentation being a huge angle. And then I also think about like the talent pool around it. Like if you're in high school and college today and you aren't just reading nonstop about AI and trying to get sophisticated there, I'm kind of curious as to what you're doing, because the whole job landscape is going to change over the next 10 years, in my opinion. And you kind of have to get ahead of that, right? Like it's scary thinking about that if you were the college age, right? Like what is the world going to look like professionally? Like I'd be jumping on that wave right now. So I don't know. It's not.
I'm sure there are jobs that we can't even imagine right now that are going to be created. And I think of my daughter's in digital media, and basically creates TikTok videos and Instagram posts, and for her career, her business, and that didn't exist 15 years ago when she was growing up. Nobody did that. And
nobody did that. But then my question is like how much of the creator stuff becomes AI? Like,
and how many of the creators become AI?
But to your point, she's using it already to augment a lot of what she's doing.
Sure, 100%. And she's smart, right? And the way we look at it internally is tools will continue to get better, for sure, no doubt about it. But where they are today, they're not going to solve for problems end to end across the board. And so you talked about claim processing, like we find the more difficult things for humans to do to be the better areas to leverage AI. So as an example, image recognition. A support agent isn't going to know whether an image was copy and pasted from Google. We see customers filing claims all the time with an image that they copy and pasted from Google. Look, my product broke. Send me a new one. I'm not joking. It's crazy. And so like a little thing like that is an easy use case now for AI. So we embed AI into our workflows. We don't believe yet that like you can just throw an LLM at a customer and it's going to solve all their problems. And I think what happens is when it doesn't solve their problems, customers immediately have a bad taste in their mouth of like, they're just throwing AI at this because it's such a hot topic button.
Yeah. Interesting. The robo-taxi war, it's Tesla, Waymo, Uber. Who do you see winning in this game?
I know this is maybe like a contentious thing to say right now, but I think Elon and Tesla are going to absolutely dominate over the next 5 to 10 years. I think they have all the infrastructure in place. They're well ahead of the larger OEMs as it relates to sort of these types of topics. And I'll tell you personally, like Waymo's park outside my house in LA all the time. I think they've figured out that it's a good like routing location. So they'll just pull up and park. And I fucking love it because I have a chauffeur sitting right outside my house anytime. And I have no problems with it because there's no one in the car. Like no one's coming outside to smoke a cigarette at 1 a.m. It's awesome in that regard. So like I'm very bullish on it. I think it'll take some time for like mass scale adoption. But like you come to SF or you come to LA, I don't know how it is in Tampa right now, but like there are Waymos everywhere, right? And so
we don't have Waymo yet.
We
don't have here Waymo. We don't have it here yet.
It'll be there soon, would be my guess, though.
But you think Elon's going to beat Waymo?
I think so. Yeah, just because they have infrastructure, they have
a lot lower costs, right?
A lot lower cost on it, and I think like Tesla has the ability to use it as a loss leader too, acquire a ton of customers through it, and I think they'll get there. So I think it's interesting for sure. It's like a crazy time in that regard, but as a consumer, I love it because it's like the car doesn't smell like shit. I don't have to talk to anyone.
You're good to go.
I'm good to go.
If you were getting out of Stanford today and starting a new company like you did, how old are you now, Rohan?
32.
Okay. That wasn't that long ago.
I had to think about that.
What would you start? What would you do?
Oh man, it's a really good question. I think like I live and breathe sort of retail right now, so it clouds a little bit of my point of view at times, because so much of what I think about is in retail right now. But I think more broadly speaking, if I were to start a company tomorrow, I would be trying to figure out and basically dive into like internal agentic use cases of AI within the corporate enterprise. Like, I don't want to touch necessarily their customer experience because I think the bar for quality is so much higher when you have to do that. Like one of my best friends, who's also named Rohan, just started a company that does like an AI agent for your ERP. So effectively, rather than having to do large scale integrations into your ERP every single time you want a data model, you can effectively use this agent to OAuth into your ERP and read and write within it. And so it creates an extraction. Like, that's such a simple but beautiful use case to me of streamlining a shit ton of cost and operational risk today. And then on top of it, it's a revenue driver, because if I can do 10 projects a year instead of 2, I now have way more opportunity as the business itself. And so like, I think you can make a pitch for both revenue creation as well as cost optimization that is just so obvious that like, in the beginning, people would ask us like, what am I missing? Why wouldn't I do this? It sounds like free money. And I'm like, yes, it is free money for you if you work with us. I think there's almost a similar pitch for a lot of those tools. So like, that's where I would play. I don't know if that's very specific for you, but
no, it's great. I think we're investing in AI startups. I think we all think that there's never been a better time to start a company. And when you think about what's available to you in the cloud, what's available to you with AI now, the opportunities to disrupt so many different markets, so many different software applications that are out there today. And it's exciting. Yeah, no, that's a great answer. Rohan, this has been great. Thank you so much. Really appreciate it. Continued success. I have no doubt you'll continue to do well, and we'll enjoy following you and watching.
Well, I appreciate it, Tom. Thanks for having me.
Thanks a bunch, man. Appreciate you being here. And if everybody enjoyed the show today, please follow us on Instagram. Please throw us a like or a follow on YouTube. Once again, Ro, this was awesome, and appreciate your time. And we'll see each other soon.
Thanks for spending your time with Skin in the Game VC today. If you want to learn more about investing in early stage tech like a venture capitalist, be sure to visit the Florida Funders website at floridafunders.com. Join our angel network at no cost and get access to Florida Funders VC vetted investment opportunities in the next great breakout tech companies.